Welcome to Stocks in Translation, broadcasting from the New York Stock Exchange. I'm Jared Blickery, your host, and with me is the voice of the people, Sydney Freed. Please like, subscribe, and comment on Stocks in Translation on Spotify, Apple Music, Amazon, or YouTube. And today we are welcoming Christopher Whalen. He is the chairman of Whalen Global Advisors. Chris was one of my early go-to sources in the global financial crisis. He's been described as a, quote, securities analyst, central banker, investor, deal doer, and author. He is the author of a brand new book coming this May, Inflated Money, Debt, and the American Dream. Nothing transitory about it. Our phrase of the day, debt deflation. It's part of Trump's new playbook, what it means for the bond market and investors. And this episode is brought to you by the number 100%. That's how much some bank loans are underwater in the commercial real estate space. I remember all those Silicon Valley banks that blew up 2 years ago, why the Fed's ongoing quantitative tightening has made things more difficult in the meantime. So Chris, before we really dig in, can we get your big picture thoughts on all the market movements we've been seeing and how things are playing out in the early days of the Trump administration?
We're kind of giving back some remarkable gains from 2024. My banks, which normally don't move that much, were up over 100% on average. You had JP Morgan up to almost 2.5 times book value, which is pretty high even for them. Jamie runs the best performing bank in the country, large bank, and yet they're giving it back now. And I think you'll see more. What was fascinating, before I came in, I looked at the top 10. Who's the top bank in the US right now? SoFi, followed by Dime Savings and Bank of New York. None of the other big guys are in the top 10.
And that's really fascinating. I want to pivot now to our phrase of the day, which is debt deflation. Debt deflation is a broad drop in prices that increases the real burden of debt, often leading to defaults and tighter credit conditions, which in turn can slow overall economic growth. Debt deflation within the context of what we're seeing in the new Trump administration, how is that playing out?
Well, it's mostly a commercial story, particularly multifamily properties, particularly in cities. Think about those old apartment buildings in New York City that were loaned by Signature Bank. And now nobody wants them. They're too small. They don't have enough square footage. They're also, in some cases, hundreds of years old. So the maintenance, everything else about those assets makes them very expensive. So they're getting ready to foreclose on a couple. The Biden administration hid billions of dollars worth of more of this stuff inside the FDIC bank insurance fund. So eventually they're going to sell that too. Trump is not going to support these assets. He's going to let them go to the market and be sold for whatever. Could be pennies on the dollar.
Can I ask you, how big is the problem? Because when I hear questions about bank health, it's usually on the consumer side.
Right.
We get these answers that consumer has never been stronger. I don't know that I've heard about any relation to the problem we had 2 years ago with some of these, Silicon Valley Bank itself and some of its cohorts. So
Right.
How big is the problem? Is there the potential for contagion throughout the entire financial system?
Not contagion, that involves surprise. Everybody knows about this. But remember last summer we were waiting for a consumer recession?
Sure.
Everybody was worried about it, interest rates were going to fall. No, this is a problem in conference rooms with lawyers on both sides of the table, institutional investors, big real estate developers. So you rarely hear about it, except in the specialty press. But I'll tell you, for big cities like New York, Los Angeles, Chicago, this is a huge problem.
So what's the ideal fix or solution to this?
There isn't a solution. You have to resolve the assets, get them back into the private sector. Only private investors can deal with this stuff. And then I think in a lot of cities like New York, we've got to start talking about redeveloping properties in the city as a widespread public policy program. Because, where's Robert Moses? We need another Robert Moses.
He's a controversial figure from New York history. I mean, he wanted to build highways through Washington Square Park, which is kind of...
That is correct. He got stopped eventually. My dad used to tell me stories about him. But the point is that the west side of Manhattan, the River Drive, all of the major improvements, the parks, the highways, all of that was Robert Moses. Now we have hundreds and hundreds of years old structures, many of which were built by my ancestors, by the way, that need to come down. They need to be fixed.
So do they need to be fixed and turned into public buildings where people can go bowling? And
I think you just have to have rolling redevelopment in many. Think about 14th Street on down to where we are now at the New York Stock Exchange. How many of those buildings are hundreds of years old, 5 stories? They don't have enough square footage to survive.
So this isn't necessarily a problem that's going to touch people all across the country, but it does affect
banks.
It does affect bank health, and so that's kind of the systemic issue here. How does that play out then? Like, what are some of the longer-term consequences for the average person across the U.S.?
Well, I think it's an opportunity for people who are willing to put capital to work and come in and buy some of these properties, knock them down and start again. They need to be repurposed. But on the other hand, you're going to see pain in the government. HUD is a big financer of multifamily real estate, about $500 billion. Fannie Mae, Freddie Mac are also in multifamily, almost $1 trillion total. So you have $1.5 trillion out of a $3 trillion market that's supported by the government. Donald Trump wants to get out. Conservatives in Washington don't want any multifamily lending at all by the federal government. So if they pull the rug out from under this quickly, if they don't do it with a little bit of sensitivity and nuance, then we have a big problem. Because, if a building isn't refinanced and it comes off of a mortgage that's guaranteed by HUD, well, guess what? HUD's going to eat the loss.
So do these bank losses eventually eat into, so the way the FDIC is structured, as I understand, all the banks kind of pay into it and they pool the losses. Does that entire program, is that at risk here?
No, but I think you could see assessments again. The assessment just to cover Silicon Valley, Signature.
Which is like a tax on all banks.
Oh, it's huge. It drove earnings down $40 billion in a single quarter. So that's how much it cost when the FDIC had to come out and essentially pay out all the depositors and they couldn't sell the assets. So, in our system, the FDIC really is only supposed to provide the capital. In other words, they give you the assets at a discount and they provide you essentially with some new capital. Off you go, right? Not this time. They had to take down the entire bank and pay it out. And they can't do it that much. So, when you're in an environment where interest rates are rising instead of falling, it's really hard to sell bad assets.
Well, that gets back to a central bank problem. And
That's right.
You mentioned the intractability of this. You said it's not a solvable problem, but when we had big problems with debt before, and this was on a global scale, and I'm talking about the global financial crisis, the answer was QE forever. And I know part of what you're talking about, and even the premise and what you talk about in your new book, is quantitative tightening. That's still ongoing.
Yes.
How big a problem is quantitative tightening? Because I don't hear much about it.
It's a problem to the extent that the government is in deficit. So every time they pay the Fed off of a treasury bond, right, they immediately have to go out and issue that bond again. An investor buys it. A bank deposit disappears. So when the Fed is buying securities, they're putting cash into the banking system. Deposits go up. That's what quantitative easing did. It grew the banking system dramatically. If you look over the last 10, 15 years, banking system has doubled. Does that tell you that inflation is low? No. So really the interaction between the Treasury and the Fed and how they manage their balance sheets has a direct impact on whether or not bank deposits are growing. So right now, they're not. Bank deposits are flat, and you know what's growing? Money market funds, because the Treasury is issuing a lot of debt.
Their cash, though, can be tapped, and we've seen this. There are mechanisms to be able to do that. And there was a bit of controversy over the Treasury issuance strategy of the Biden administration, kind of issuing more short-term bills as opposed to the longer-term bonds. Is that an issue? Is that something, because I've heard Besson talk about that he wants to extend the duration or the weighted average maturity of the U.S. debt profile, and that just means instead of borrowing short-term, borrowing longer-term. Is that on the agenda, and how does that play out?
Well, it wasn't just the Biden administration. Many administrations going back 20 years have been keeping it short because at the time it wasn't a problem. They figured it was a better way to manage Treasury's debt. But now that you have $36 trillion worth of debt and almost a quarter of it is in T-bills, it puts a lot of pressure on the Treasury. So let's say you're Scott Bessent and you want to increase the allocation for 10s and 30s in the next auction. Rates are going to go up. There's not that much of an audience for longer term Treasury debt because most of the people buying it today are hedge funds and other speculative parties, not banks so much. And the short term stuff, it all goes into money market funds. It's very safe, 1 year or less, right? They don't want to take a loss. So they tend to focus on very short-term paper. So the question is really, how much of a market is there out there for 30-year bonds?
At 5%, maybe a big one.
But I think, honestly, I was going to ask Bessent this. They didn't take questions when he spoke at the Economic Club of New York. But I think at some point we have to just start issuing more. I don't want to see T-bills get over 25% of total debt. I think they need to draw a line. And as rates go up, as the cost goes up, that's going to be part of the conversation with the Congress. No more continuing resolutions. We have to pass a budget next year and actually start cutting.
All right, we need to take a short break, hold that thought. But coming up, we're going to be talking about bank loan problems in the housing sector and an historical presidential runway face-off on today's Who Wore It Better. This episode is brought to you by the number 100%. And that refers to losses on bank-owned multifamily loans that are averaging 100%. And this is a quote from Chris Whalen's work here, UPB of the defaulted loan amount, an indication of the serious trouble affecting this $600 billion asset class. And we touched on this before, these multifamily residential buildings. I guess going in the direction that we have, how does this affect the everyday average American?
Well, it affects Americans because it's going to be harder to find a place to live. It's going to be more expensive. For example, say you're looking for a rental apartment. If developers are out there getting shellacked, taking big losses on existing properties, it's going to be more difficult to get them to invest in new properties, which is what we need. We need to replace a lot of our existing stock with new assets. So right now, if you think about it, banks, when they're taking 100% loss post-default on a multifamily loan on, say, some apartment building, think about the guys who finance these buildings that aren't banks, because the bank portfolio is relatively prime. These are pretty good assets. This number actually normalized almost immediately after COVID. So on the one hand, the banks are taking an absolute beating on multifamily. Meanwhile, residential is fine. There's absolutely no sign of stress in the residential loan market except for really low-income households, like the bottom quarter of the entire stack, if you will. The rest of the market, conventional loans, big jumbos, for more affluent families, nothing. I mean, the loss rates are extremely low.
Where does the residential versus commercial loan, how do you explain that to someone who doesn't really know the difference?
Well, the way I think about residential is it's all of our homes.
It's me applying for a loan.
That's right. It's a government market. The government guarantees most of those loans, but there is a substantial private market for larger loans. So really anything over $1 million, you're going to just go to a bank. But, it's an important market. It's absolutely crucial, whether you're talking about smaller loans from HUD for first-time home buyers, or you're talking about that $500,000 or $750,000 house in the suburbs somewhere. All of those assets, all of those homes fit together in an economic ecosystem. And when they start running into problems, the economy suffers dramatically. The good news is we don't have a consumer recession. We keep waiting for it. We keep talking about it, but it's not happening.
Want to get back to markets a little bit. It's been really interesting when President Trump was first elected, going back to last November, a number of sectors took off. Banks were one of them. Financials, they just took off, and the thought was deregulation. And now we're hearing more about these problems, how bank margins could be impacted, and that's kind of the death knell when you think about their stock price. So where do you think the opportunities are for investors this year, like right now?
What I have told my flock is that they got to be patient and wait.
Okay.
The market.
Cash?
Well, no, not cash, but my portfolio right now, I don't own any common in banks. I got out in 20, mostly preferreds. And I like to wait until everybody's running around going, the sky is falling, and then I go in and buy them. But they got very expensive. Preferreds actually ran up a lot because people are looking for yield. People are concerned about the future. So what do? They run the yield. So what I would tell you about the banks is they're going to give up more ground. We're going to have credit costs up this quarter. We're going to still have flat deposit growth. You don't see loan growth unless you have deposits growing. So until the Fed stops shrinking their balance sheet, you're not going to really see much growth there. And then meanwhile, the money market funds are competing with the banks very effectively.
So is there a point, what's the threshold? What's a point at which you think banks become investable again, the common shares, for instance?
Well, look, one of the names I've written about very positively is Wells Fargo. They came roaring back last year after being in the doghouse for a while. Now that Trump is in office, we have new regulators. All of the regulators are going to have to sing off the same song sheet, by the way. That's what that executive order meant when Trump said you have to submit your Federal Register postings to the White House for approval. It's more than that. I mean, Jerome Powell has to report
a single source of truth for the banking industry.
well,
and the
one
regulators.
policy, one set of rules, which I don't think is unreasonable.
I mean, currently, you break it down. We got the OCC, the FDIC, the Federal Reserve,
That's
you got
right.
the state regulators. Am I
That's right.
missing something?
No, and the state regulators are going to go insane because the CFPB has been dismantled.
Yeah.
So they're going to be putting in place all sorts of regulations on mortgage lenders, their own versions of the Community Reinvestment Act. It's going to be a mess. But, I think for banks, once you start to see some deposit growth, once the Fed stops shrinking the balance sheet, then you're going to see loan growth much better than we see today. They're rebalancing a lot of those low coupon securities they bought during COVID. They're getting rid of that. We're starting to see a lot of sales. And I think over time, they're going to be much more investable. My sense is it's going to be a mid-year opportunity. I always like to buy things when they're kind of, sort of back to where I got out, like NVIDIA. We're getting close to $1,000 to pre-split split price. That's where I would look at it again. But I would look at the better performing financials. I like the ones who are paying attention. So Bank of America, no. JP Morgan, American Express, the people who didn't have a mark-to-market problem coming out of COVID because they were paying attention. Charles Schwab, no.
They didn't have to write it down.
Well, yeah, but when you see somebody with a yield of 1.5% on their mortgage backs, and we're writing sixes today, that tells you they were not paying attention. I don't know how these people still have jobs.
What about just your basic XLF ETF? Yes, no.
Mid-year?
Right now, mid-year.
I don't really trade the ETFs. So I'm a
Okay.
stock picker.
Yeah.
I do my work.
You did mention NVIDIA, though. So I'd love
did.
to get your talk on AI.
Well, I covered semiconductor capital equipment for a few years as a banker.
I did not know that.
Oh, I
You
love
were-
it. It was
yeah.
like a science project every day. Sure, let's use copper in lithography. What a great idea.
You ever talk to Gordon Moore?
No, but I got to meet a lot of people in the industry. But the guys who provide the inputs to semiconductor manufacture today are all commodities. You never even hear the names of the companies anymore. Remember Applied Materials?
Sure.
There were all of these companies we used to cover. They're now just swept into the larger industry.
So NVIDIA buy later in the year? Buy
No,
now?
I own some now.
Okay.
If it gets a little cheaper, I'll
Yeah.
probably buy some more.
Yeah.
I own AMD.
Yeah.
Probably my biggest winner is Williams, the pipeline operator. I love that one. I've been accumulating that for years. I have a contest with some of my friends to see who can buy the most Citicorp TRUPS, the 9 3/4. They're hard to buy, but
Well, the stock is still 80% down from its global financial price high. So.
Look, Jane's down from a couple of years ago, and I got to tell you, we need to merge that company with somebody else and start again. Maybe Goldman will create Frankenstein's monster, right? Because Goldman needs deposits, right? Citi,
Always.
they sold their asset management business, so what do we do with that? We're going to do subprime lending on the consumer side and kind of try and rebuild the private bank. And then the payments platform, that's the most valuable asset inside a city is the payments platform, right?
All right, we got to pivot here to our fashion showdown of historical and presidential proportions. So we have two economic disruptors separated by nearly 2 centuries taking to the runways today. On the one side, we have Andrew Jackson, the original populist firebrand, striding in with his hard money swagger, fresh from dismantling the second bank in the United States, leaning towards hard money of the golden and silver variety. And on the other runway, we have Donald Trump, the self-styled billionaire populist who built an empire on debt and now campaigns on an American first fiscal agenda. So he's quick to slap on tariffs. He loathes trade deficits and is not afraid to shake things up economically. So who is wearing the disruption better, Chris? Jackson or Trump?
That's a tough one. Jackson left this country in chaos. He required everybody pay for taxes and tariffs in gold. And he also required that if you wanted to buy land out in the West, you had to pay gold. You couldn't use paper. So it caused horrible deflation. And this is right before the Civil War, remember? And, off he went back to Tennessee. And I think Trump, though, could be potentially more disruptive. Some of the things he is doing had to happen, like Bretton Woods, we're done with that, I think. NATO, has that kind of gotten to the end of its life? Probably. But none of the other politicians wanted to talk about it. So he was willing to essentially pick up on a lot of conservatives who had wanted, change for a long time, and he's doing it. And this time, by the way, they are prepared. Unlike Trump won when he didn't expect to win, this time he was expecting to win, and they organize themselves accordingly. So they are putting butts in seats, and that means they can make policy.
So what do you think ultimately about Trump's tariff policies right now? Disruptive or ultimately helpful?
I think they are ultimately helpful. We needed to make changes. We can't continue to subsidize the rest of the world, which is what we're doing. I thought it was interesting that Mario Draghi, the former head of the ECB, wrote a great piece in the FT scolding his European colleagues for having more trade barriers internally within the EU than the United States is imposing with tariffs. So all we're saying is treat us fairly. Don't put up non-tariff barriers to our products. I think it's totally appropriate. We need to have a more balanced relationship with the rest of the world. And if it means that the dollar is not going to be the only reserve currency, fine.
You've alluded to this several times. Post-Bretton Woods, we got about 1 minute. What does that look like?
Again, it means the dollar is not going to be the focus. It means central banks will hold other currencies, particularly for their trading partners. And I think that's a healthy development. You know, the dollar is a utility that we run for the rest of the world. It is expensive. We pay for it with trade deficits, and now, as you see, we pay for it with inflation internally. So I think it's appropriate to make changes, and he's using the threat of tariffs to essentially force people to change. That's okay.
So just with about 30 seconds left, what are people really misunderstanding about the economy right now?
I think they are waiting for a consumer recession. It's probably not going to happen this year. Everybody keeps wringing their hands. Larry Summers. Let's remember how wrong Larry was in 1982, okay?
I don't.
He was totally wrong about Volcker and inflation and everything else. I don't know that tariffs necessarily are going to cause an economic slowdown in the U.S., frankly. I think quite the opposite. Besant's saying 3% GDP growth. Maybe not, maybe 2%. But this economy defies all of the naysayers. Every time people say, oh, well, the consumer's going to roll over, they don't. And it's in the numbers.
We're going to have to leave it there. Really appreciate you stopping by. And that is going to do it for us today on Stocks in Translation. Be sure to catch out other episodes on your podcast platform or the Yahoo Finance site.